Hey guys, it's Adam Rose, Vice President and Senior Loan Officer of Western Ohio Mortgage, located here in Sydney, Ohio. And this is another episode of the Mortgage Guy podcast. And this is one where you're going to learn a little bit about cost and expense, as well as a couple of individual loan products, specifically USDA, is what we're going to dive into today. So the reason I wanted to talk about this a little bit is there's a lot of misconceptions out there about what you can do with certain products, where you can buy, what the costs are, what's the out-of-pocket expense, things like that. So I wanted to kind of put those to bed. So USDA is a very popular option here in my area, here in Shelby County. It is a rural-based program, but there's a lot of misconceptions with it. People think they need a large down payment, or they have to have like a 780 credit score, or hey, you can only buy that out in the country, or it's for farms. It's none of the above, right? Or all the above, you could say. So what we can do with USDA is a very neat program. It is rural in nature, but if you're watching this program, most likely you're watching it from the Shelby County area or maybe the closer surrounding areas. So Shelby County, Darke County, Auglaize County, Mercer County, Logan County, Champaign County, they're all 100% eligible for USDA financing, even in their micropolitan towns, right? So like here in Shelby County, we're in Sydney, and even in Sydney, you can use USDA financing. You don't have to be out in the country. Now, there is a USDA eligibility map where you cannot purchase your home, right? And you can take a look at that if this is a program that you're interested in. So USDA is a rural development program again. And the big benefits here are it's a no down payment mortgage, right? That's huge. In today's market, with what's going on and inflation and the cost of housing and everything that's happening, being able to go with a no down payment mortgage and some additional flexibility with that program is huge. It is huge. It's very flexible in regards to credit scores, down to about a 600. Some say you can go a little bit lower. I've tested that water, and sometimes it doesn't work out. Some will tell you get over a 600 to go USDA financing. Again, no down payment. It's got very low PMI. The rates are very, very competitive. They're very, very similar to what you might see with an FHA mortgage. The nice thing about it also is you have the ability to finance some stuff into the program, right? So let's say you're out there negotiating on a home. Maybe the seller doesn't want to come off of the sales price or doesn't want to help cover with some closing cost expense. Well, you are allowed to finance that into your mortgage on USDA financing. However, you have to have enough appraised value, right? So example, buying a house for $100,000, you need, I don't know, let's say $5,000 towards closing costs and prepaids, and you make your base loan amount 105. Well, the appraised value has to be at least 105 to make that work, right? Because you can only go up to 100% of the appraised value of the home or sales price of the home, whichever happens to be less in this case. Other nice, neat features to the USDA program is we have the ability to do a renovation loan attached to it as well. So if we run into some of these homes that might need a little bit of upkeep, but maybe the borrower can go with a conventional option, the USDA renovation is there as well, and it's fantastic because we can finance, again, up to the appraised value. When we do this, though, let's say, I always want to do examples so you can kind of grasp it a little easier. So let's say we need a new furnace, okay? So we're buying a house for $100,000. We get a furnace or an HVAC estimate for, I don't know, $8,000. We finance that into the loan. Now we're sitting at 108. Again, our appraised value has to be 108. Now the question becomes, well, just because we're doing this doesn't mean we're going to have enough value to do it. The big thing here is that the appraiser is actually going to get the estimate as well. So they're going to give us an after improved value, which may help us out a little bit. So that's always something to take into consideration when you're looking at some of these homes, and you might see a house that just needs a little bit of loving. Not a lot, all right, don't go crazy, but something, maybe some updating. You can go as far as, kitchen cabinets and even appliances. But we like to try to stick with the program with, hey, what's needed to get this house up to par, whether it's peeling paint or GFCI outlets or whatever it might be. But that has that flexibility. So that's part A, and that's just a broad, brief brushstroke over the USDA financing and some of the benefits it has for the buyers, and especially in our rural areas, okay? Remember, you can still use it in town, and we will share that map again, that link to the USDA eligibility map here, so you can kind of check out where you cannot purchase, right? Because there's more places where you can than you can't. But let's talk about some out-of-pocket expense. Okay, so we get that question a lot. Hey, what's this going to cost me out of pocket? What are we doing? So let's take out closing costs and let's just take all that stuff out of the equation right now. Let's talk about what we need to get prepared for when we are purchasing the home. Okay, number one, first thing. Okay, obviously after you get your pre-approval and you get your offer in, you get your house accepted. Okay, what's our next step? So typically it is getting your inspection set up, right? So with USDA financing, okay, there is no requirement for you to obtain a whole house inspection. That does not mean you shouldn't get one. We always highly recommend that you get one so you know what you're walking into. This industry is always a buyer beware type of industry where you may, we can't see everything. The appraiser's not going to see everything. And you may run into a situation where as soon as you start occupying the home, something goes south on you, whether it's a water sewer backup, something happens, right? So we do recommend taking that step, getting that inspection done. So I've seen a wide range. I'm not going to quote people, but I've seen them anywhere from $275 all the way up to $450. Okay, it depends on how deep they go, what additional services you are obtaining on that whole house inspection. So please have a conversation with your lender, myself, or your real estate agent. We have plenty of referral partners that we can send you over to so you can get that quoted out. So always recommend getting it done, but not required for financing purposes. Okay, so let's say we are purchasing a home and it's out in the country. All right, so we'll go to town here in a minute. There's a little bit of a difference. So out in the country, the only required inspection to be done for USDA financing is a well water test, okay, a well water test. And what they're testing for USDA is called coliform. So they're testing your drinking water to make sure it's safe. Usually this test is going to run you $50 to $75. We used to be able to take it in ourselves for like $25, $30 to a local lab. Now, you, the buyer, the seller, even the agents involved in the transaction are not supposed to be doing the water sample. They're not supposed to be going out there testing it and then sending it in. I think they ran into some problems with that where people really weren't testing the subject property. They might have been testing their own home or something like that. So that's changed. So now we have inspectors that usually just go out there, do it. It's $50, $75. That is something that you should be prepared for, okay? So that is a hard cost that you may incur. Also, the whole house inspection that we suggest that you should be prepared for, okay? Now, the only other inspection that you may need to have when purchasing a home out in the country, and we don't run into it a ton, is if a home has been vacant for a little while, right, 3 or 4 months, something, or even longer, a lot of times we're going to want you to get a septic inspection. There's a lot of things that can go south when you haven't had water running and running that stuff through there, and especially backup issues and air getting into the pipes and stuff like that. So we do recommend that, and sometimes an underwriter will require it, again, assuming the home's been vacant for an extended period of time. Okay, so that's something to also be prepared for, which we can always help you out and refer you to some places that do that. Other than that, that's the inspection piece of it, right? Let's talk about other hard costs. So you have an appraisal, okay? Every lender's slightly different on how this operates, but almost every independent mortgage banker like ourselves in the country, we have to order through something called an appraisal management service, okay? This service is truly a service, meaning they have to get paid or receive money to do said service, okay? So we will advise clients, hey, be prepared. You'll have your appraisal costs. Again, depending on loan program, you're going to be ranging anywhere from $500 up to $625 for VA. So just sit right there in the middle, assume about $550 for your appraisal costs. But that is a hard expense. We've had clients say, well, hey, our agent said that it can be wrapped up into our closing. Yes and no, right? So here's why I say yes and no. Could we shoulder it ourselves? Yes. Do we get burnt when we do it? Yeah, we get burnt a lot, right? So we stop doing it. And what I mean by this is when we order an appraisal, they have to receive the money, whether it's you paying for it, whether it's me paying for it on your behalf, which we stopped doing, because they have to get paid to do the service. It is a third-party independent review. The money does not go to said lender. It is going directly to the appraisal management company. So let's say you're tight on cash or whatever it is, and you're like, hey, is there any way you can float me for right now? Or, hey, can we push this to closing? Sure, I'll work with you. Great. We get that done. Let's say the home doesn't appraise out. Let's say you decide to back out of the transaction. The appraisal was already done. You need to still pay for it, right? Because if I've paid for it on your behalf, that means it's money out of my pocket, an expense for a home that I'm personally not purchasing. You, the buyer, are, right? So that's why we want you to be prepared for this, okay? So let's assume $400 for an inspection, $550 for an appraisal. So you're about $1,000 out of pocket, give or take slightly, right? Because whole house inspections do vary and, again, are not a requirement for financing. But these are the things that you should be prepared for. You shouldn't be window shopping for a house, and if you can't pay for an inspection, it's really probably not the best time to move forward in the market. It really isn't. You got to be prepared for this. Start saving for it now. There's a lot of great savings tips that we put out there on Facebook to help you achieve this very quickly. So I highly recommend looking into starting that process now. So one other program I wanted to talk about real fast is FHA financing. So FHA financing is really making a pretty large comeback, right? With the mortgage insurance drops and stuff that's going on with conventional financing and pricing. So FHA, we've been doing a lot more lately, and they're very similar to USDA in regards to what they require for inspections. Always had misconceptions that they've required termite, they don't require any of those, right? Do we recommend you get a termite and a septic? Yeah, sure, of course. Gung-ho. We want more inspections than what we can, more than enough, right? So we want to make sure you're protected and you're getting into a situation that you're not going to have a bunch of repairs to do after you get into the house. So the main primary difference between FHA and USDA, so let's talk about loan program first. So FHA is a 3.5% down loan program, okay? So you have a minimum required investment of 3.5%. So if you're buying a $100,000 house, $3,500 is your investment into said transaction, okay? So you have to be prepared for that. There's a lot of ways to get there. Checking and savings, accumulated savings. You can use your 401k assets, retirement assets. You can cash in life insurance. You can get a gift from family. There's some additional things that we have to do with the gift. Cash, no, all right? Just stop. No mattress money, all right? I'm tired of trying to document cash. You can't do it. Now, do they have some leniency on how much cash you could deposit in the bank? Yeah, they do. You can do up to 1% of your purchase price. Just don't recommend it because an underwriter is going to question it, okay? So be prepared for that savings and tell your lender where that money might be coming from for that down payment, whether you're cashing out some retirement assets or whatever it might be. So that's the primary difference between those two loan programs in regards to out-of-pocket expense on the loan program. Now, the inspection piece, right? So on FHA, we're going to stick with country, right? Because in town, when you're on city water, city sewage, there's nothing required for the programs themselves. So out in the country with FHA, the main difference, again, is the water test. So with USDA, we had to do a coliform test, pretty inexpensive. With FHA, we have to dive into something called a full panel, all right? On that full panel, and I hope I don't mess it up. I'm doing this from memory, right? So we're going to get coliform, we're going to get E. coli, lead, nitrite, nitrate, okay? There's 5. Now, if we're using an inspector, they understand what those are, but now usually these tests come about $125 price tag. So that is something that you need to be prepared for as well, okay? Depending on the inspector, sometimes we can throw it on the closing, all right? And we can put it on your closing disclosure and pay out to that inspector at closing. A lot of times, I'm going to say probably 90% of the time, the inspectors want to get paid, right? Because they're doing all this work. They're taking it to the lab. They're getting charged by the lab. They want to get paid. So it's just a heads up on that program. But those are the primary differences between the two programs. And we just wanted to come on here and just kind of give you an idea. Hey, let's be prepared for these purchases. Let's pinch some pennies. Let's start saving and get ready for those whole house inspections. If you want to get some termite inspections, you want to get all that stuff done, and for your appraisal. Those are your hard costs up front when purchasing a home. And we want you to be ready and so we can get this transaction through as quickly as possible. So I just wanted to touch on that this week, guys. Again, a little short on the video, but hopefully it was helpful. And if you do have any questions, don't hesitate to reach out to us at 937-497-9662, and we can answer whatever specific questions that you have about your property or about your loan program that you're going through so we can advise you correctly. And that's it for us this week, guys, on the Mortgage Guy Podcast. Again, like it, love it, share it with your friends, subscribe on YouTube, and make sure you like it or listen to it on Spotify and Apple Podcasts while you're on the road. Have a great week, everybody.